Okay, in this problem we're going to go over diluted earnings per share for a complex capital structure. The problem starts by saying Hill Inc.'s capital structure is as follows. And they have 2011 220,000 outstanding shares of common stock, and by the end of 2012 they have 294,000 shares of outstanding common stock. They have 12,000 shares of non-convertible, non-cumulative preferred stock, and $800,000 worth of 10% convertible bonds. So, the following information is available. On September 1st, 2012, Hill sold 74,000 additional shares of common stock. They had net income for the year ended December 31st, 2012 of $920,000. During 2012, Hill declared and paid dividends of $6 per share on its preferred stock. The 10% bonds are convertible into 50 shares of common stock each for each $1,000 bond. Unexercised options to purchase 25,000 shares of common stock at $24 per share were outstanding at the beginning and end of 2012. The ending market price of Hill's common stock for 2012 was $34 per share. Warrants to purchase 36,000 shares of common stock at $36 per share were attached to the preferred stock at the time of issuance. The warrants, which expire on December 31st, 2017, were outstanding at December 31st, 2012, and Hill's effective income tax rate was 30% for 2011 and 2012. So what the problem wants us to do is figure out basic EPS for the year ended 2012 and compute diluted EPS, or earnings per share, for 2012. So, for basic earnings per share, these are our numbers. Net income of $920,000. You get that from this right here. Dividends on preferred stock, you have 12,000 shares times $6. During 2012, Hill declared and paid dividends of $6 per share on its preferred stock. So, you subtract the 72,000, and you have the net income applicable to common stock is 848,000. Then we need to find weighted average shares. So, from January 1st to September 1st, we had 220,000 shares. It's right here, 220,000. And then we sold 74,000 additional shares of common stock. That raised that to 294,000. So for 8 months out of the year in 2012, we had the 220,000. So you times those, that's 146,667. From September 1st to December 31st, we had 294,000. So you times that by 4/12, because we had 294,000 common shares outstanding for 4 months out of the year. That's 98,000. You add those together, and that gives you 244,667. If we divide that, if we divide the net income applicable to common stock of 848,000 by the weighted average number of shares, 244,667, we get basic earnings per share of $3.47. Okay, now we need to find diluted earnings per share. So, on these convertible bonds, 10% convertible bonds, $800,000. We need to test for dilution. So you take the interest net of tax per $1,000 bond. So somewhere in here it mentions, okay, so what you do is you find their effective tax rate. Hill's effective income tax rate was 30%. So you have a $1,000 bond times 10% interest, but then you multiply that number by 70%, and it's paying out $70 in interest per bond. So you divide that by the number of shares, and you get $1.40 per share. Okay, we need to mention or explain the 50, I guess. The 10% bonds are convertible into 50 shares of common stock for each $1,000 bond. Okay, so that makes it clear. You have the $70 paid out in interest net of taxes per $1,000 bond, and each one of those $1,000 bonds is convertible into 50 shares. So you divide that $70 by 50 shares. That gives you an an incremental EPS of $1.40, and it is less. It's less than $3.47 per share, so it is dilutive. That's what that means. So then we go back and we take the net income applicable to common stock, net income for diluted EPS, net income for basic EPS right here, and then we add interest expense net of taxes on convertible bonds. You have $800,000 times the 10% times 70 to give you net of taxes. That's $56,000. So you add those two together and you get $904,000. Okay, now we need to find the weighted average shares outstanding for basic EPS. Or we don't need to find that, we already did that. Then we figure out incremental shares. So you have the 244,667 for basic EPS. Then if we assume that these options are exercised, unexercised options to purchase 25,000 shares of common stock at $24 per share were outstanding. The ending market price of Hill's common stock at the end of 2012 was $34 per share. So with that information, on the assumed exercise of options for 25,000 shares, then you subtract the repurchase. So you assume that the shares would be repurchased from the proceeds of the options. So you take the 25,000 shares times $24 per share. That is $600. Then $600,000. Then you take the $600,000 and you divide that by the $34 ending price, and that gives you 17,647 shares. If you take that away from the options, number of shares from the options of 25,000, that leaves you a 7,353. So those are the incremental shares. Add that to 244,667. That gives you 252,020. And then you have the shares assumed to be issued on the conversion of bonds. 800,000 divided by 1,000 times 50. That gives you 40,000 more shares. You add that to 252,020, and then you divide this number, net income for diluted EPS, by 292,020, and that gives you diluted earnings per share of $3.10 per share.